You say, Howard, that one of your strengths as an investor is knowing how to think about the future probabilistically, effectively evaluating the odds against available information. Howard, I want you to think probabilistically. We've started a new year. We've started a new decade. Does now strike you as a good time to be investing?
I would say probabilistically it is not, because if you look, the market's been up for 11 years. It's quadrupled off the low. We're in the longest bull market, the longest expansion in history. Profits are not rising. Stock prices are. It's what we call a liquidity-driven rally. That means it comes from people having a lot of money to spend. If you put those factors together, it doesn't mean that the market's going to go down tomorrow, but it does mean that the odds are not, in my opinion, in the investor's favor.
Is that to say that now is the time, Howard, to be a contrarian? Because as we both know, the economy is growing at a reasonable clip. Forecasters say the odds of a recession in 2020 have declined. Stocks, as we witnessed last week, brushed off, right, the threat of Iranian hostilities and surged to a new record. And of course, high yield spreads keep edging closer and closer to a new post-crisis low.
Right. Yes, well, the way I would phrase it, Eric, is that this is a time to have less risk than you did 3 or 5 years ago. You know, 3 or 5 years ago, we were here, and now we're here. All things being equal, if we're here, we should have less risk than here. And I don't know whether we're going to go over the cliff tomorrow or continue straight up to the sky, but the odds are less in the investor's favor, in my opinion, than they were 3 or 5 years ago.
Howard, I want to get to the substance of your new memo.
Yes.
You call it You Bet.
Yes.
Frustrated investors say the stock market is no better than a casino. Are they right?
Investing, as I point out in the memo, involves hidden information, luck, and skill. And the question is, how much skill does that investor have? If you don't have much skill, then you're down to luck and hidden information, and it becomes a coin toss. But if you have skill, you can perhaps have an edge. It's the difference between roulette and poker, or blackjack. You know, a lot of people, there's a science to playing blackjack. There's books written about it. You can actually get good at it.
Bill Gross got awfully good at it.
That's right. You can get so good. Ed Thorpe wrote the book called Beat the Dealer, and he was barred from the casinos. He was too good. So you can get good at it. You can turn it into a skill game. But most people who haven't read the book and don't know the theory and don't study it, for them it's luck. And they go in and they sit there, I don't know, should I hit 16? Should I stay? And if you don't have the skill, then you shouldn't expect to be able to control the outcomes.
Let's assume,
yes,
for argument's sake, if not because it's true, that most people lack the skill required to be a superior investor.
Yes.
What should those people do?
In any other activity, dentistry, law, veterinary, we pay people to do the things we can't do. So that's what they should do. They should get outside help. Now, for decades, they went to equity, let's say mutual funds, and they paid 1.5% a year to other people to run their money. More recently, it turns out, maybe equity, investing in the big stocks, efficient market, it's not a skill game, it's a luck game. So the hired hands can't do any better, so you shouldn't pay them either. And if you don't have a manager who has an exceptional skill, and exceptional means rare, then you should go into an index fund, which does not presuppose skill and doesn't charge for it.
What if what we believe to be the efficiency of a market is more a function of the availability of data and the computing power that can be harnessed to process those data, as in large cap stocks? We used to think that generating a superior return in the stock market was a matter of skill, but it seems, to your point, that history has demonstrated that to be illusory. It's very, very hard.
It's very hard
to beat the index.
Yes, and by definition, you know, in Lake Wobegon, which Garrison Keillor wrote about, all the children were above average. I'm confident that not all investors are above average. Some are above, some are average, some are below. So only the exceptional ones should be expected to have the skill required to be superior investors.
What isn't the same thing going to happen to all the other markets, Howard, as they become indexed? That's increasingly beginning to happen in your area of specialty, the credit market.
Yes. Well, you know, I like to believe that there is skill in, let's say, high-yield bond investing, and of course that we have it, and so that we'll be able to, through credit analysis, cut our risk without cutting the return fully commensurately. And that's the definition of outperformance. But we'll see.
Howard, you say in this memo, which I encourage people to read, as always, you can find it on the Oaktree Capital website, that investors often make the mistake of overlooking what you call the proposition.
Right.
Which in gambling is effectively overlooking the odds.
Yes.
Now, we know how catastrophic it is to overlook the odds.
Right.
In gambling, just talk to somebody who bet on a football game and didn't look at the line going in.
Right.
Can I translate that as buying regardless of price as a recipe for disaster?
Absolutely. You know, my book, Mastering the Market Cycle, which came out a year and a quarter ago, we talked about it. If you go in the index, you can look up no price too high. And there's a lot on that subject. And I think that no price too high is the ultimate sign of a bubble, of a widespread error. And it's, as I say in this memo, it's not what you buy, it's what you pay for it. And any given stock or other investment can be good or bad. Bad if it's expensive, good if it's cheap.
I'm going to ask you a this time is different question.
Yes.
And make reference to a chart, which I hope we can bring up, of Microsoft. Microsoft's stock price relative to Microsoft's price to earnings ratio. So the price to earnings ratio you can see in blue, and the stock price is the white line. And the point I'm trying to make here is that at any given point, Howard, you could have said, wow, Microsoft is awfully expensive, too rich for my blood, I'm not going to buy. But what the stock price demonstrates is, regardless of the valuation at which you bought Microsoft, the stock kept on going up. Right. Is this time different?
Well, you know, Eric, it's the price always matters. The price may, you know, if the price is 10 or 20% higher than it should be, that may not be enough to turn it into a bad proposition. I talk in the memo about the Nifty 50, IBM and Xerox, Kodak, and Polaroid.
Back in the 1960s.
50 years ago, they were so expensive that they made good companies losing investments. So the price can be too high. You can, if you looked at that chart, you see that there was a while when the price was ahead of the earnings, and as a consequence, a long period in which the stock didn't do anything. But maybe it's not so much too high that it turns it into a bad investment.
Howard, we've spent some of this conversation talking about indexing. Most people know indexing through a three-letter acronym, ETF.
Yes.
The other three-letter acronym that we've come to accept and, if not understand, in the post-crisis period is the CLO. Yes. The CLO is a direct or indirect consequence of post-crisis bank capital rules. We're going to be hearing a lot from banks over the course of the coming week, Howard. Is the credit market, in your opinion, better off or worse off without the bank capital that used to fuel it?
No easy answer. We're better off. We, as lenders, are better off because it's a bunch of competitors we don't have. But you know, if people hear, oh, direct lending is great because the banks are inactive, if too much money rushes in as a consequence and tries to invest too aggressively, then that's bad news. So, you know, we have to take account of all the considerations, not merely the bank's reticence.
Does it feel to you like too much money has rushed into direct lending?
I would say so.